So again, I'm just going to read from the WhatsApp conversation. I sold IRN shares in a panic yesterday, but happy to. I made a good profit. I can buy back in again if they start going up. So like, you know where I want to go with this one, right? It's I can buy back in again if they start going up. And it sounds simple, but it's fatally flawed as an approach, because you're not going to do that. If you've got out of a stock, like say IRN, and you made, maybe you've 4 or 5x your money, turned, a couple of thousand into like tens of thousands, who knows? And then you sold it because you're like, oh, it's going down. I've got to lock in, bank my gains. And it starts going down. Well, you're fooling yourself when you say, I'm going to buy back. Because if it keeps going down, like you'd always be looking for the bottom. You'd be trying to find the bottom and you won't catch it. You won't catch it. So if it keeps going down, you'll be like, oh, I'll just wait, one more day, one more week, one more month. It'll keep going down. And then when you miss the point, because it starts going back up again, because everything just operates in cycles. When it starts going back up again, you'll be like, oh, I missed the bottom. So I'll just wait for it to get back to where it was like 2 days ago when it was really down, and I'll buy it then. But now it's going up and you feel like you've missed the boat. And you're like, I can't buy back in now because I could have bought in for, $10 cheaper a few days ago or last month. And you never get back into this position because you've tried to market time. You failed unless you were incredibly lucky. You failed to time the bottom perfectly. And then you've anchored, like you've fixed your mind on this price that you could have bought the stock at, which you probably never see again. And if you do see that price again, well, it's going down. So you'd be like, oh, I better wait and let it really, really go down. Like you just make life so hard for yourself. And if you, like the simple answer is, just don't do that. If you, yeah, exactly. Right. Like there's a slightly more advanced approach, which is you might trim a bit. Like last week, I talked about trimming Axon because I think it's incredibly expensive at its current valuation. I haven't got out of it altogether. So there's no price in my mind where I'm anchored to and going, oh, I sold Axon at so many dollars. I'm going to buy it back at so many dollars. It felt expensive. So I just took a little bit off. I reduced my exposure. And that's a way of navigating that. But if you want to keep it really simple, just buy good quality companies and hold them for a long time. Don't mess with them. If you really want to keep it simple, don't even look at your portfolio, like coffee can, some of this stuff for decades and then come back and just kind of see what happened.
2 points, Badge, strategy-wise. One, also taxes. Most people have to deal with taxes. So I another thing I found that the very hard way, when you kind of sell in and out, you're costing yourself money.
Yep.
The moment you sell a position, if you have gains, you owe money. So you're literally triggering a outflow of capital versus doing nothing. The second point is on the back of what you just said, Badge. I think this is sound for investors of all levels of experience. Start with not one portfolio, but whether it's one account or it doesn't, there's a way to divide your investment portfolio into, I would call, different buckets or cans, like you said. And as a start, I would do something like 90% is your long-term stuff and 10% is, call it, monkey business. But the 90% one, and of course it's personal to everybody and that would require different kinds of analysis, but for argument's sake, in the 90% portfolio, once you buy something, you ain't selling unless a thesis that breaks.
Yep.
In the 10% one, because it's only 10%, in theory, it's not, you can give yourself a little bit more, call it the momentum stuff. And I don't want to take us to the field, but what I'm trying to emphasize is proportionally, the 90%, if that continues to just sit there and do nothing, you're going to be way more than fine. And then you could give the smaller one over to your impulses and you could feel like you're doing something. And then you learn whether it's being effective or you're playing a game and you're losing at it and you make adjustments. But even if you completely screw that up, your 90% will still be fine.
Yeah. And if you're like totally new as an investor, like your 90% might just be like some index trackers and, you know, big funds and like market tracking stuff. And maybe your 10% is like, this is the money I'm going to learn my lessons with, where I'm going to make mistakes with, feel the emotions, and then, you know, build my skill set over time.
Yeah.
Yeah. Yeah. I want to add on to your comment about tax, because it's a really good one. Like there is a real cost. If you do what Sarah did and, you know, you buy a stock and it goes up and then you sell it and you plan to buy it back, even if you were successful in doing that, there's a cost every time you trade. So Sarah's account is an ISA. So it's like a tax efficient type of trading account in the UK, but like a Roth in the US. So she doesn't have any capital gains, but there's still a true cost to her because there's a bid-ask spread. And if you're using like a really simplified trading platform like Trading 212, which is what I use in the UK for my King of the Jungle portfolio, and it's a good product for smaller accounts. Like they don't even show you the spread. They sort of simplify it. They just one price. But if you were to go onto there and you were to try and buy a stock and then sell it like a couple of seconds later, if the price hadn't moved, you will lose a little bit of money. Like when you simplistically, so you go to the foreign exchange bureau, you want to change like your dollars into euros because you're visiting Paris or something. You know, there's like the buy price and the sell price. Well, stocks have that as well. And the gap is known as the spread. And if you trade too often, you're going to pay the spread a lot of times. And that's going to, and eventually that could wipe you out. It's a fee. Plus, it's slightly worse for ISAs in the UK. I mean, they're an incredible account. We should all have one. Like, well done to Sarah for having one, but you have to settle into sterling. So she does actually pay the US dollar to pound exchange rate every time she trades. So like simplistically, my advice to her on the WhatsApp was like, just assume you're losing 1% every time you do a trade. And it might only seem like it's only 1%, but you know, if you sell everything and it's like, say, £10,000 and you buy it back, well, that costs you like £100 twice in those 1%. So like they do add up.
Yeah. So you know what I think the TLDR here is? I could see it so clearly. I'm going to reemphasize. There are multiple games played in the market. Both can be won. When somebody buys a company and then sells it because price is dropping, they are, by virtue of their actions, admitting they're playing the short-term game. In this case, your friend thinks of herself not as a short-term player, however. She thinks of herself as a long-term investor. So she made a categorical error. She basically forgot the game she was playing and broke one of the cardinal rules of the long-term buy and hold game.
Yep.
Hopped over to the short-term game where she doesn't have the skill set or the understanding to win that game. And she's basically set herself up for losing. So know the game you're playing and then go from there.
Yeah.